So, Digital Realty Trust is a stock that has not had a very good year or so. It is down by about 50% from its highs. That's dramatically underperforming the real estate sector as a whole, underperforming the S&P 500. And it's not just Digital Realty, to be fair. Other data center REITs have done poorly as well. And the kind of thing that confuses a lot of investors is this is a type of real estate that should not only be in demand in the years to come, but should grow in demand in the years to come. So there are, I mean, if you're not familiar with what a data center is, think of it as kind of the physical home of the internet. So when you upload photos to your Facebook page, or when you access a cloud-based application, or you're watching a YouTube video, all of those, all of that data has to live somewhere. And that's where data centers come in. They're kind of big, secure facilities where companies can reliably house their servers and other networking equipment. So the amount of data flowing around the world has grown exponentially over the past couple of decades. More devices are connected to the internet than ever before. More devices per person exist in the world these days. But a lot of the tech trends that are in the very early stages are very data heavy, such as artificial intelligence. We've seen like Chat GPT and things like that. Internet of Things, meaning just internet connected devices. I can look from where I'm sitting and see, about 10 things that are connected to the internet, including a lamp, a vacuum cleaner, all kinds of stuff. So as more things are connected to the internet, the more data is going to be flowing around. 5G technology enables the flow of more data around the world. Augmented reality devices, autonomous vehicles are very data heavy. And these are all in the early stages. So these should create long tail demand for data center space over the years. So, what's the problem? So, there are five different concerns that I have when it comes to digital realty. And to be clear, I'm still a shareholder. I haven't sold any of my position yet. I am on the fence as to whether I want to reduce it or not, but I haven't done so yet. The first concern I have, and this is kind of actually the most minor of the five for me, is that it's a target of short sellers, specifically Jim Chanos, who actually has a really impressive track record. He is the one who called the Enron collapse way back when. He has a really good shorting track record, and he recently called data center REITs his new big short idea. And sure enough, when we saw SEC filings on his 13F for the end of the year, or I'm sorry, for the end of the first quarter, sure enough, Digital Realty Trust and its chief rival Equinix are the number one and two positions in Jim Chanos' portfolio. His main thesis is that the three dominant cloud providers, Amazon, Google, and Microsoft, are building out their own data center infrastructure. That may be true for their own needs, but I really don't buy the thesis that they're going to be taking customers away from companies like Digital Realty Trust in large numbers. I don't see that happening. Building data centers is a very capital intensive business, and quite frankly, those three companies can do better with their capital than just investing it in a bunch of real estate. That's why REITs exist, because it's not economical for a lot of businesses to own their own real estate. So I'm not terribly concerned, but this is something that's definitely worth watching. Um, a few things concern me more. The debt load is a bigger concern for me. Digital Realty has grown fast in the past few years through a lot of acquisitions and partnerships and things like that. It costs money, and it's reflected in the balance sheet. Their debt to EBITDA ratio has increased from 5.7 to 6.9 since the end of 2021. Not only that, but one fifth of the company's debt is at floating interest rates. So some of it gets more expensive as rates rise. And it has $2.7 billion of debt maturing before 2025. So that's also a pretty big concern. Number three is lease expirations. So in any given year, for most commercial real estate companies, a single digit percentage of their leases are going to expire, unless you're talking about apartments. But with Digital Realty, 27% of their leases, including the majority of their smaller customers, are up for lease renewal this year in 2023. and another 25% are up for renewal over the next 2 years. That's more than half of its leases that are up for renewal over the next 3 years. And that's in a weak environment for tech companies, which are Digital Realty's main tenants. I said most of the expirations are smaller customers. The company has reported releasing spreads that are a negative 3.6%, meaning that it has to cut rent in order to get customers to renew. That's in sharp contrast to most types of commercial real estate, which are seeing record high releasing spreads in the current environment. So that's also a big concern. Number 4 is asset valuations. So commercial real estate values are falling. That's no big secret. A lot of experts have said that there's a problem in commercial real estate right now. And Digital Realty plans to sell up to $2.5 billion of its assets this year. Now, 75% of those sales are expected to be its core assets, not just excess access assets that it's been holding for a long time. These are its core stabilized data center properties. And cap rates are rising, which is kind of an inverse measure of real estate valuation in commercial real estate. Digital Realty recently sold a property for about $150 million at a cap rate that looks to be greater than 10%, which is kind of horrible for commercial real estate. So some of its asset valuations are troubling. And last but certainly not least, the leadership shakeups recently. The company fired its longtime CEO, Bill Stein, who had a great track record of outperforming the market in December, didn't really say why. The former CFO, Andy Power, is now the new CEO. And recently we learned that the Digital Realty's 2 longest serving board members who have been with the company since its IPO in 2004 are also stepping down. So again, I'm not concerned enough that I'm going to hit the sell button today, but these are all definitely things to watch. And I think right now at the current valuation, it still makes sense to own. The dividend yield, as I'm talking, is a little over 5%. So you're getting paid nicely to wait for some of these things to play out. So I am holding on to mine for now, but I will revisit this, especially after the next quarter's earnings report comes out in a few weeks, and I will be sure to report back to you guys then. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. So go to fool.com/Frankel to get your 10 stock picks right now. The Motley Fool Stock Advisor returns are 381% as of March 23rd, 2023, and are measured against the S&P 500 returns of 113% as of March 23rd, 2023.